Good morning, traders. Today is Sunday, the 24th of April. Big move in the markets last week. Really, everything that I've been telling you is going to take place over the last 15, 16 months of talking to you about the shifting in trends and how the markets have peaked. And I'll show them to you here on the charts. But everything that I've been talking about is starting to really come to fruition. And I'll give you the short picture without trying to freak you out. The Fed is raising rates. The Fed is trying to fight inflation. Inflation has kicked in because of the excesses of post-COVID. We've had global central banks running very easy money policies, stimulating things, trying to prevent a crisis from happening after the global shutdown. Well, that's wonderful in the sense that we averted a shutdown, but we also pushed excessive price levels in housing. Demand constrictions have ramped up, meaning demand excesses have ramped up. Supply constriction because of the shutdown in labor and continued off and on shutdowns because of COVID has continued to disrupt the market, which has put inflationary pressures on. The Fed is pushed to make a move. They cannot keep rates at near zero, given what's going on with inflation, giving inflation the fact that consumers and the global markets are dealing with excessive gas, food, raw material, and other costs. And this eats away profit in corporations and individuals. So hypothetically, if you think of an individual family, say you have two income earners and they've gotten into a house or they've moved recently, and they're now looking at, $1,000, $2,000, $3,000 or more in a mortgage, which is fairly stable, but there are other costs, food, gas, vehicles, just normal things have gone up 2 or three times the normal expenses. So hypothetically, if they were spending $1,200 a month for food and gas and normal expenses, now they're spending $2,400 to $3,500 a month for those extra expenses, and that's going to eat away excess capital. That's going to become a draw over time away from their budget. And that's going to push a lot of people into making hard decisions. It also happens in corporations, and it also happens in other factors, nations, global nations. The other thing is debt. Credit debt is excess, and it's been very easy for the last 6 or 7 years for people to borrow with easy money, low interest rates, low credit card rates. Everything has been fairly cheap up until about 2000, July of 2000, when everything started, or 2020, when everything started really ramping up. And now we've seen some excesses. Food's gone through the roof, gasoline's gone through the roof, just the cost of basic materials have gone crazy. And so essentially what we're looking at is the same thing that happened, very similar, in my opinion, to 2008, 2009. The only difference is the Fed, Alan Greenspan, was a little bit ahead of the curve as far as he raised interest rates a bit more aggressively between 2004 and 2007. Right now, the Fed is way behind the curve, and they're going to potentially start to raise rates excessively. If they start with a 0.5 point rate increase in May, remember they did a 1/4 point rate increase a couple months back. This is going to represent a 750% increase in borrowing costs over a very short period of time. If they continue to raise rates above, say, 1.5%, that's going to represent a 1,400% increase in interest rates, possibly more, over a very short period of time. And that's going to become very deflationary for the economy. So we're in a very weird transition right now, in the sense that the markets are reacting to risks and contracting consumers. For example, Netflix loss of users is twofold. Number one, they raise their rates, and people have to determine whether or not they want to keep Netflix for the $14 or whatever it is a month. But number two, all of these other cost factors are rising up, and they've had to decide for themselves whether or not they want to keep Netflix on top of having to pay twice as much for gas and twice as much for food and twice as much for other supplies. So what's happening is people are going back to what I call the toothpaste and toilet paper mode. They would rather put gas in their car and provide for basic necessities than pay for extra things like Netflix or Hulu or Disney or what have you. And as these pricing pressures continue to play out, you're going to see more and more of a contraction across the globe with regards to these excesses. And this is going to be what essentially breaks the Ponzi scheme, which is this low money cycle, this low cost money cycle that's taken place over the last 7 or 8 years. Remember, this has been basically a great big Ponzi scheme where if you can borrow for zero and do what you want to do with that money, say you borrowed $1 million for zero cost and you had a business that could turn a profit of, say, 7%. So you could borrow money at zero, earn 7% on that money, and service that debt at zero and just keep rolling it over because the cost factor on that debt is really simple. So theoretically, you could take other people's money, make 7%. It doesn't really cost you anything. Well, now that cost of servicing that debt is going up. And as it goes up, as well as inflation pricing going up, cost of raw materials goes up, your 7% profit turns into 3.5% or 3%. It goes down because your costs are going up, your labor costs are going up, your material costs are going up. Those factor into it. Now you start taking away the easy money, zero interest debt cycle or credit cycle, and now that's going to start costing you, say, 4.5% or 5.5% instead of 2% or 1% or less. Now you have a scenario where you're net negative. If you were making 7% before, with all of inflation and easy money, maybe more, but now that's gone down from 7% to 3%, and your cost of servicing the debt is now at 4.5%. You're negative 1.5% and going upside down with a huge amount of debt. The Fed is talking about telegraphing rates even higher, meaning that this whole scenario could unwind, and it's like a big Ponzi scheme unwinding. So we're going to have a very interesting set of circumstances over the next couple of months, possibly years, going forward. So let's start here with the Fangs Index. It moved dramatically lower. We still haven't gotten below the lows. I expect this is going to break down over the next couple of weeks, moving into a very deep downward cycle, possibly like what happened in 2008, 2009, and the dot-com bubble burst. The similarities between the dot-com bubble and what happened over the last 2 or 3 years in technology is incredible. Easy money policy and people at home because of COVID, having stimulus with very low cost factors. Remember, back over here, nothing had really changed with regards to cost factors. By this time, cost factors, homes, and other things had started to accelerate. And by this time, we'd started to see quite a bit of acceleration in commodities and others. This is all now starting to unwind. And it wouldn't be surprised, I wouldn't be surprised to see us move back to 2019 levels, which is back in this area. And from that point, from where we're at now at about 1,000 to down to 600, that would be a 40% decline potentially in the Fangs Index. Understand that these are real numbers. We could see a 40 to 50% decline in the NASDAQ and in global technology stocks simply because of the unwinding of this factor. If you take a look at the longer term picture and you really look at this lower channel, remember, this was still excessive stimulus here. This was still stimulus in 2019 and 20. We were still at zero interest rates. In reality, we could be back down in the 600, 700 level within a couple months. So you could be looking at a 40% decline in the stock market, in technology, potentially within 4 to 6 months, given what's likely to take place with the Fed and how aggressive they are. With regards to the U.S. stock market index, this is pre-COVID, 2018-19 back here. This is 2019, the peak. This is COVID. The lows down here at 580. This is my U.S. stock market, custom stock market index. We could roll below this level and move back down into these mid-COVID levels down here near 800 from where we are at 1150. Doing some quick math on that, that would be about a 25 to 30% decline in the U.S. stock market, possibly even deeper. Now remember, this is all around the concept that the Fed is going to continue to push rates higher, thinking that the economy can handle it with the excesses. And certain corporations may be able to handle it, but I don't believe consumers have that kind of depth right now. So remember, we're looking at a very strong potential, especially if the Fed moves at 0.5% next month. The smart cash index, which is the global index, has already shown a fairly solid depreciation from 210 down to 150. This is essentially a 23, 24% decrease. I think that we're targeting down here in this 136, 137 level, possibly even deeper. But the global markets have already unwound. This also includes, excuse me, this also includes China, Hang Seng Index, and Nikkei Index, and the Deutsche Bank Institute, the DAX. So understand that I believe that we've already seen some declines here. They could fall. I mean, in reality, because this is Nikkei, Hang Seng, DAX, SPY combined, we could see this move all the way down to the $110, $100 level on a deep, deep selling phase. And this is where you need to be prepared, which is why we've moved away from risk at this point, and we're looking at just basically trying to keep everything in cash to try to save our capital to get back into these markets. Now, we could trade the inverse on the downside here, but we don't have any solid breakdown yet in the U.S. markets. I'll show you that here in a minute. Gold, on the other hand, the metals index moved lower, which it does when fear is a bit excessive. We're still in a solid uptrend. Follow the yellow brick road, so to say. Follow these yellow lines. Gold is still in an uptrend. We could see gold move back down into the 1920, 1905 level, in the sense that this would be a deeper pullback trying to reestablish support. Remember, the same thing happened back here during COVID. It went down. These are weeks. So understand that it went down because of COVID, dipped down below this yellow line, and then rallied back up 3-4 weeks later. Excuse me again, a little tickle this morning. And we could see the same thing happen back over here, retesting this 420 area, which would be roughly 1900 in gold. And I would urge you to stay very vigilant about watching metals and looking for opportunities going forward, because gold will rally back up. And as fear continues to elevate, and this washout happens, which is essentially margin calls and people potentially just protecting their assets. Let me get a drink here. Hold on. There we go. Gold will rally back up again. So be prepared. We're looking at a good move here in metals. The valuations index, which is essentially tracking the SPY technology index and the global market index compared to treasury yields, is collapsing. And this is because yields are raising higher. Now, we don't have any recent history of this. We do have this period here, which is 2020, end of 2020, which is a depreciation phase where global markets attempted to raise moderate interest rates. Then we had this waning through an inflationary period. Now we're seeing the U.S. markets and the global markets contracting even further. And I believe we're going to go way back to normal levels. That's going to put us way down here in the 40, 41, 42 levels. That's another 50% decline in the valuation index from here. And that gives you a good idea of what we're looking at. We need to find a bottom here, folks. We need to find some revaluation phase where we can attempt to move forward. And I don't think we're there yet. I think we're still floating around in clouds right now. Commodity to gold index is moving downward. Commodities are deflating a bit. This is going to happen as consumers are pulling away. You're going to watch this likely move way down into this lower level and stay here for a period of time. This was, I extended this out, 2017, 18. This was really, ladies and gentlemen, this was a rise in commodities. This was essentially easy money spurring people that were working into buying commodities, buying gold, buying silver, buying houses, buying raw materials, upgrading their washer and dryers. This is essentially the rally in 2017, after the elections in 2016. Then we had this rollover in 2018. Deflation moved us back below this 2.0 level, roughly 2.1 level. We saw the Fed spur back again with the economy recovering through this 19 level, collapsed during COVID, and then we saw the reflation after COVID, a bit of a stall after reaching peaks in July. This is right before the election, during the election, and then a huge rally after the election. And this really stems from, political change. We had easy money, stimulus, all kinds of things taking place, and this was just an excess. This is a huge excess rally that took place with regards to commodities and with regards to consumer demand post-COVID. Now, we've seen this deflation on the backside, and I expect it to continue to move lower. The volatility index is down to 8.9. The 8.9 level is not critical. So you can see over here, 8.9 has been moderately bullish at times. We have this downward trending slope here, which is concerning. And again, we have this downward move here on moderately strong volume last week. I believe we could get below the 6 level this week or retest these levels. Down here in this 6 level, in a downward sloping market, we are looking towards bearish trending. This was close to bearish trending, as I mentioned. I needed to see it move below 6 here. It's got to get below 6 in reality to break below this trending. You can see how the COVID collapse happened here, and you can see how as long as it's in a sloping upward trend, we're okay. We've seen this recovery post-COVID back up to these excessive highs. Now we're in a sloping downward trend, lower high, lower high, lower high. I believe this is going to break downward and move back into this 2-4 level down in this area and stay in this level possibly for quite a while this deflationary trend takes place. So get ready. We may be literally just a few weeks or a few months away from seeing some sort of a very big downside move. Okay, next we're going to go to the market gauges. U.S. markets are mixed short-term, mixed right now. The S&P is still long, and others are quite mixed. I'll show you. Long-term, it's still bullish. So we don't have any long-term signals yet telling us we need to get out of the market or stay focused. I am advising you to move out of some of your excessive stock positions. You can always get back in later if things stabilize, but be cautious right now. I believe we're at the early stages of a potential downside move with the Fed trying to push rates higher, which, as I explained earlier in this video, is going to really discombobulate the global markets. U.S. stocks, I have our allocation at 10%, and I have us at moderately bearish, okay? Cash, I think, is a good, safe position right now to be sitting in 60, 70% cash. Metals, I would advise you, if you're not already positioned in metals, to look for lows below 1925 in gold. And we'll look at silver here in a minute, but I believe, say, below 21 or so would be 21, 22 would be a very good silver's position. And bonds are looking for a bottom. We have a little bit of bonds to hold into this position in case it turns around very aggressively, but we're just going to hold into a small position, ride it out, simply because bonds are likely to bottom here. And I think it could be within the next couple of months we start to see a very big rally in bonds. Next, we have the, wrong direction, the market trends. And what we're looking at here, ladies and gentlemen, is very simple. NASDAQ is short-term bearish, long-term bullish. S&P is long-term bullish, short-term bullish. YM is short-term bullish, long-term bullish. Industrials, long-term bullish, short-term bullish. Transportation, short-term bearish, long-term bullish. SPY, short-term bearish, long-term bullish. Gold, long-term bullish, short-term bullish. Silver, short-term bearish, long-term bullish. Oil, long and short bullish, long and short-term bullish. Now, let's go take a look at the charts. So bonds here, we'll start with bonds. Very close to bottoming. I think we could get down into these lower levels here. This is COVID, and I think possibly we're going to push back down into these lower levels, 112, 113, before we find some real support. But again, we could see, depending on what happens, we could see a multi-year rally setting up over the next couple of months, which we're going to jump back into and try to ride that rally in the next phase. Let's come up here to the Dow Jones is long-term bullish, short-term bullish. you can see this cycle phase that I showed you last week with regard to the excess phase top. We're breaking below this phase. The next move, ladies and gentlemen, in this, if this continues to do what I think it's going to do, is it's rallied up. This is what's called an excess phase top pattern. It rallies up, comes down. This is the blow off peak, sets up an upward channel, breaks down, finds some support somewhere, possibly down here in the 2019 peak levels, sets up a sideways rotation, and then breaks lower. So now, this is the sideways rotation, possibly right around these 2019 peak level. And what this means is that if this pattern continues to play out, this is what we're looking at. This next move, if these numbers are correct, is going to put us at a 14 to 15% downside move in the Dow Jones, which would be possibly a 20-25% downside move in the NASDAQ. And this is what I think is likely to take place over the next couple of weeks and months. The transportation index is, there's my drawing from last week. Same setup, by the way, long-term bullish, short-term bearish. We're looking again at a breakdown here. We need, in order for this pattern to confirm, we need to see this establish new lows. So understand that the next phase is to come back down, try to find some support. This will be short-term support. People will start to buy into this area thinking it's the end, and then it may break down even further. SPY, long-term bullish, short-term bullish. The S&P E-mini futures, long-term bullish, short-term bullish. The NASDAQ futures, long-term bullish, short-term bearish. You can see we've got the same breakout pattern over here, ladies and gentlemen. I can draw these over and over again, but they're appearing in every index. We've gone through those. Gold, long-term bullish, short-term bullish. Now over here I drew that at the apex we could have seen a bit of a rotation. So let me get rid of this and try to show you here that because of this new weakening market trend, we may see the 1920 area, these recent lows, potentially come back into play, possibly just below 1900 as it tries to find support and then rally up higher. And I do believe we're going to see a move above 2000 before the end of May. So understand that this is just a washout period where people are pulling away from the markets, and I believe that we're going to see 2000 very quickly if this plays out the way I think it's going to play out. Silver, on the other hand, has been stagnating and stalling. We could see a move back down below 22, 23, back down into these lows. It is long-term bullish, short-term bearish. The long-term chart could end up moving back into bearish territory briefly as it rolls lower. Remember, we do have this very strong support between the 21 and 22 area. That puts us down into this area. So we could see silver move back below 24, below 23, and back down into this 2230, 2250 area. And boy, oh boy, would that be a great opportunity for traders to try to load up, in my opinion. This support level is likely to hold because fear will drive the traders into metals as this whole thing starts to play out. But right now we have, just like we saw in COVID, look right over here at COVID. COVID happened, the silver collapsed. And this is, again, but it collapsed from $18 down to $16 or $12. And if we get a move anywhere down here in $17, $15, boy, is that a huge opportunity. Because look at this rally that took place. This silver rallied from this low up to this high, 157% over a month and a half, 2 months. April, May, June, July. It was about a quarter, about 5 months. But we could see the same thing happen between now and say November. We could see it move down to $17 here and then potentially back up. I'll just show you here. And this is my drawing from earlier. We could see it pull back into these areas, stall, and then rally up into this area, which would be, again, another 130% rally from that type of move. So get ready. There's going to be a huge opportunity in gold and silver over the next couple of weeks and months if this thing plays out. I don't believe it's going to see a deep, deep move. I think it's already washed out a lot of that. I think there's huge momentum in here already. But I would suggest that this $19 to $20 level in silver is going to be an excellent area to buy. And I would suggest that the 1920 down here in this area, let's call it 1900. Anything below 1900 would be a superior buy in my opinion. But again, the 1900 level looks really solid, and that puts us right around here, ladies and gentlemen. I don't believe we're going to get back down into these areas, although we could. So be aware, we could see it fall all the way back to 1750, 1800, trying to find support before taking right back off. Okay, so now let's go take a look at the mid cap. Mid caps have collapsed lower. They are long-term bullish, short-term bearish. Take a look at the VIX. The VIX is up at 28 again, starting to really rally. We've seen this move. Understand 30s and 40s in the VIX is quite high compared to these 12s and 13s back here where we were. So we're in a very excessive volatility phase right now, and I wouldn't be surprised if we see a big move, push it back up above 50 or 60 over the next couple of weeks. Transportations, we've already gone over. Short-term bearish, long-term bullish, could flip to bearish here any minute or any day. And let's take a look at real estate. This is the IYR, and IYR is holding up. It has not moved into bearish territory yet. I do believe this is going to be the next big shoe to drop as consumers simply can't afford to live with higher inflation and afford these extremely high house prices the way they are. So be prepared. I think we're looking at, if I can show you again, an excess phase peak requires the markets move up, establish a peak, roll over, which is the first stage of the excess phase peak, then set up a sideways channel like we're seeing right now, and then break down to establish some level of support, possibly in this area, and then break down even further. So understand that we're very similar to an excess phase peak pattern in real estate, and that means that as rates increase, we're likely going to see prices come down. And the Fed is no joke right now. In order to control inflation and get this under control, they are likely going to disrupt global markets and valuations going forward, which means you need to be very prepared to address your assets in a way to protect and save. The smartest thing for you to do, honestly, is just move to cash. Get out of your positions. Maybe put something into like a government bond or more secure fund if you have your money in a 401k or an IRA. But the long and short of it is this is no joke right now. Heads up. This is going to be a pretty violent move, in my opinion, and it's probably going to take 12 to 15 months to settle, maybe longer. Okay. This is pretty much the update today. We can come back over here and take a look at these charts. If you take a look at my NASDAQ chart, which is a very clear picture with a lot of lines on it, I know, but this is my research, and I want you to just see here where we're at. Go to weekly. So here's our big move. This is the COVID rally right here. Fallout, big rally, tightening channels, broke out of the channel, came down here to establish these lows. And what I want you to understand again, ladies and gentlemen, is this is our little recovery phase here. So if I were to try to draw this, sorry, mouse is moving a little quick. I changed my mouse speed the other day and seems to be a little too quick. So if you look at this here, this is our, let's call it our upper channel, probably closer to this. And this. There's our peak, our pullback down to these lows, our upper channel, our breakout. At this point, ladies and gentlemen, once we get past this 13,000 level to the downside, we're going to be looking for some sort of support. I believe that that support level is likely going to come right in this area. So this red line or potentially this blue line. So let me draw this right here so you can get an idea. Something like that would be our intermediate support level. That means that we would likely see the NASDAQ move down to here, try to find some support, and then move lower. Now, if we take a look at pricing, this means the NASDAQ could fall 15, 16, 20% maybe, then try to find some support, then try to fall potentially another 25 to 30%. So you're looking at overall a potential move of about 40% to the downside in the NASDAQ if this pattern plays out and if the Fed continues to push things. Now, this will revalue things to 2019 levels and understand that that may be the bottom. That may be where we try to find a bottom. We could see things go a bit lower, though. So be prepared. I'm just going to tell you right now that if you are smart and you've been holding throughout most of this big rally, the smart thing for you to do is to pull away from the markets, move into a cash position, pay down your credit cards or off your credit cards, and ride this out. This is going to be a huge opportunity when it happens. Gold and silver look just fantastic to me. Longer term, you see here we've got these huge rallies. This is gold. You can see here we've got these support channels. So if I were to consider drawing support channels, across here is the lower support channel, and then across, well, you got one here that I've already drawn. Let me see if I can extend this one. An intermediate support level right here. Of course, my mouse is not going to cooperate. I want to change this to a little bit more green. And what we have here, ladies and gentlemen, is this is really the area of support I'm looking for gold. So if gold were to contract because of what the Fed is doing, gold could come back down into this area, try to find some support, and then just take right back off. And I'm talking in a matter of 5, 6, 7, 8 weeks, potentially. So we need to see what happens here, and then this could be off to the races. All right, that's it for now. I've given you a pretty good update. And again, things are changing at Mint.com. We're going to try to offer you research for free because now you need to really be aware of what's going on. Ideally, we may be changing things down the road, asking for small subscriptions. But right now, we're going to give it away for free until we decide what we're going to do with our subscription services. You can contact me for consulting or programming or any other services that you need along the way for development in TradeStation or NinjaTrader or eSignal or others. I've been doing this for many years, writing modeling systems, so I'm sure I can help you if you need it. Anyway, guys, that's the update for now.